For me, this is one of my favorite regions to talk about. We've been optimistic about the region for a long time, and actually, when you look at the data, that optimism has been borne out over the last couple of years. In fact, I'd argue that the region is an economic success story. I think when you look at virtually every indicator out there, they're moving in the right direction. There's lots to be optimistic about going forward. Yes, we are strong in our traditional sectors, logistics and things like that, which we hear about all the time, but we're far from a one-trick pony. In fact, I want to go through some data today that shows how we're not just a logistics area, and we're not just an area that's full of cheap dirt and things like that. There's a lot of exciting emerging sectors, a lot of improvements in the quality of life, and a lot of signs of things that are really good going forward. That's not to say that there aren't challenges, there are, but our long-term outlook for the region, for inland Southern California, remains really positive. And I think when you look at the trends as well as the assets that we already have here in place, what you're going to see is that our optimism is really well founded. That's not to say that we don't have those challenges, but for me, I think the good news is that the challenges that we have remaining out there are of a structural nature, and given that the cycle is behind us, we're going to have that wherewithal from an economic standpoint, from a revenue standpoint, to begin to address some of those longer-term challenges now that we're not in this kind of crisis management mode any longer. We can really start to chip away at some of those issues that really have been bubbling under the surface. Again, nothing that's going to unseat this expansion over the short run. And of course, a lot of these things, as Chris noted, will have to be tackled in Sacramento, things like CEQA, things like Prop 13. But overall, from a local perspective, things really are moving in the right direction, and I want to go through some of those topics here. I figured before we got into the trends and the cycles, it would be really helpful just to kind of go through our vital statistics, right? What's our resume look like here in inland Southern California? And I think it's important to note just how big of an economy we are. We really are one of the larger economies out there. In fact, we're about the size of Pittsburgh, Indianapolis, about the 24th largest economy in the U.S. overall, $133 billion economy as of 2014 last year. So really are not just a big economy, but an important one for the entire nation. Of course, I mentioned we're about the same size as some of these other larger economies, but I think what's even more important is that we're one of 11 large, quote-unquote, large economies that are greater than $100 billion a year that actually saw their ranking in terms of the overall U.S. percentage actually increase over the past 10, 15 years. There's only been 11 of those, and we're one of them. And I thought it was also helpful just to point out who some of those other economies are, because I think when you look at what other areas are growing and outpacing national growth such that their rankings are increasing, we really are in good company, right? We're talking about economies like Austin, Houston, right? Seattle, Portland. These aren't economies that are known for just being areas with cheap dirt or affordable housing or things like that. We really are part of this, and it's for good reason. There's a lot of positive things happening. So we're a big economy and we're a growing economy. In fact, when you compare us to those top 10 economies that I'm showing you here above that black line, we're growing faster than almost every single one of them. The one exception there is in Texas and in San Francisco, which is really on fire. So not only have we increased our rankings, not only are we a really big economy from a U.S. standpoint, we're also growing faster than most of these other quote-unquote strong economies that seem to have gotten some kind of a better reputation for whatever reason. I think for me, the optimism that we have is really borne out by these statistics. That's not to say that we don't have our challenges. We do have a big concentration. This is labor market concentrations measured against annual average wages. So everything above that red line, that horizontal red line, are sectors they're more concentrated here in inland Southern California than what they are in the rest of California and the U.S. overall. Some of those are on the left-hand side of that $40,000 average wage. So you're talking about things like tourism, like retail. But we're also more concentrated in several other things that pay above average wages, things like logistics, like healthcare, like wholesale trade, and even construction, where we're more concentrated in some of these sectors that do pay a relatively decent wage. That's not to say that we don't want to see those concentrations in things like professional, management, scientific, technical, information technologies grow, but we are seeing that there are pretty strong contingents if you will, of some of these higher wage categories. And of course, those high wage categories are some of the ones that are growing. Yes, logistics is our single largest concentration in terms of overall labor force. One thing to keep in mind, and I'll touch on this a bit later, is that this really is reflective of the firms located here, not necessarily indicative of the skills base that we have, which is, again, one of those assets that I think we really can leverage over the short and medium term to really kind of grow these sectors. But none of that withstanding, you can see the sectors like professional, like finance and insurance, like management actually growing as a share of our overall economy. Our concentration in these, although we're not more concentrated than the rest of the state, our concentrations in those sectors are in fact moving forward. So we're becoming more and more diversified, and we're seeing the kind of growth in sectors that we really want to see continue to emerge. How about the business cycle? There's no doubt that the recession hit the inland region very hard. We were ground zero for the housing issues and the foreclosure crisis that followed. There's no doubt about that. But when you look at the economy today, we're vastly in a recovery mode. GDP continues to grow. We've had almost 5 consecutive years of GDP growth. We're still about 3.7% below that pre-recession peak, but we're growing at about 3.5%. So we should get back to that pre-recession peak over the course of the next year. When the 2015 numbers come out, I'm confident that you'll see even more growth, and you're seeing that right now on the labor side of the market. What's even more encouraging for me is that virtually every sector of our economy is growing in terms of overall output. So on the right-hand side of this chart, I'm showing you growth on a sector-by-sector basis from a GDP standpoint, and you can see that with the exception of utilities, mining, which is a pretty marginal component of our overall economy here in the inland region, and real estate, which is really a function of rental and leasing opportunities, every other major sector in the region is growing. That's true of logistics. Yes, that's our stalwart mainstay that's been around for a long time, but you're seeing it in manufacturing, professional services, information, construction. I mean, virtually every single category, you name it, and we're growing. So this isn't just something that's isolated to the logistics sector or something that's being driven by the ports of Los Angeles and Long Beach. This is really broad-based growth that runs right the way across the spectrum of our economy here in the inland region. Do we have more work to do? Absolutely. But the good news is that we're not just having all of our eggs in one basket and relying on one sector to kind of carry us forward. We really are seeing pretty broad-based growth here locally. The labor markets are not in a recovery mode anymore. In fact, we're largely recovered on the labor market side. So we're back up above that 1.3 million job point that we had in the pre-recession period. So we've recovered all of those jobs lost during the downturn and then some. The unemployment rate has ticked down nicely. In fact, we've actually chipped away at our unemployment rate faster than in the rest of the state, such that we've narrowed the gap between what you see in the rest of the state and in this inland region. We're currently sitting at about 6.4%, slightly elevated relative to a quote-unquote normal economy, but nonetheless making very, very solid strides on the labor market front. In fact, we're outpacing California, and we have been doing so for the better part of 3 years, actually more than 3 years, right? 41 months consecutively that the inland region has outpaced California. So this isn't just something that's being driven by the Silicon Valleys of the world. The inland region really is one of the growth engines for the entire state and nation overall. And I think it's also important to point out that it's not just that we're outpacing. We're not just growing a little bit. We really are one of the drivers of growth. In fact, I'm measuring from the bottom of the downturn when the state labor market hit bottom back in 2010. We're actually the third fastest growing economy in the entire state, right behind, or fourth fastest, depending on how you measure San Luis Obispo, but we're right behind San Francisco and San Jose. In fact, the 195,000 or so jobs that we've added is right on par with how many jobs we've seen created in the Silicon Valley. So, don't count yourselves out. Don't believe everything you hear in the media about the inland regions being in a depression or, things being worse off than they ever were before. In fact, we're taking part in the recovery, and in fact, we're one of the driving forces that's moving the entire state forward and punching above our weight in the sense that we're keeping up with places like San Jose and San Francisco, which have a great reputation. But, if you look at the numbers, inland Southern California is where the action's happening. We're also creating, a lot of jobs in some of these above average wage categories. Yes, you can see some of these big bubbles in things like tourism, but you're also seeing big bubbles, a lot of job growth in categories like healthcare, like logistics, even professional services, wholesale trade, 6,500 jobs on the construction front. So yes, we have created a lot of jobs at the lower end of the wage scale, but we've also created a lot of jobs at the higher end of the wage scale, including things like professional services. So, for me, again, I don't want to sound like a broken record, but I think it bears reiterating because of what we hear a lot in the media about how the Inland Empire really is a one-trick pony, and it's just whatever happens at the Port of Long Beach in LA is really going to drive the day. Not the case. We have our own domestic sectors, a lot of emerging sectors. In fact, when you switch this over from a picture of how many jobs have been added to what's the rate of growth in some of these categories, what you can see is pretty interesting. You see that logistics, stays pretty strong, but we're seeing shrinking bubbles in things like tourism, and the bubbles for professional, scientific, technical are getting larger. So we're growing at a faster rate in some of these really high-wage, high-skilled categories. They started out as a smaller base. These aren't our traditional sectors that have always been the kind of strongholds for the region, but they're actually growing at a disproportionate rate. Logistics, tourism, healthcare, those are all doing well, but they all started from really high levels. So, you can have smaller rates of growth still translate into a lot of jobs in some of those categories just because we started from such a high level. But, when you look at what's emerging and you focus it on a growth rate perspective, what you see is some of these really desirable categories growing that are really going to boost the quality of life and business opportunities for everyone in the region. We're even getting back in the saddle on tech. I know we hear, we think tech and you think Silicon Valley. And that's true to a certain extent. They're, the home of the tech sector. But we have our own domestic tech sector as well. In fact, it got hit pretty hard during the downturn. Saw a lot of firms go out of business and things shrink up. We heard Dr. Farouk talk a little bit about the incubators that we have going on here in the region. In fact, you're already starting to see growth in new quote-unquote tech firms. We've added more tech firms, almost 105 new firms just over the course of the last year. Some of these are large, some are small. A lot of them are small, fledgling industries. But, for me, it's really encouraging and really signs of some emerging sectors and things that are really going to start to happen in the region and things that you want to continue to watch looking forward. If I had to make my prediction now on the basis of only what we've seen this far, I would say that these are some of the sectors that you really want to keep an eye on. We're talking about things in professional services, things that are growing. Even, computer and systems design is one that, isn't traditionally associated with inland Southern California, but we've got, over 540 computer design manufacturing firms here in our local economy. So this isn't just something that's happening, again, in the Bay Area. This is something that's happening right here in inland Southern California. And I think, for me, one of the ones that you really want to watch out for, if I can figure out, I know they showed me this, how to get the laser working, is this other physical and biological research. That's our quote-unquote biotech sector, and we've seen a lot of good growth there. 53 firms jumping up, over 350 new jobs in that sector alone. We have the medical school coming to UCR. We've got a lot of these incubator efforts going around, and so if I had to put my pin on any one of these individual quote-unquote tech sectors, I'd say that biotech one's the one to really keep an eye on. That and the graphic design services are things that I think are going to continue to do really well, and we're going to come and be talking about this at our 9th annual forecast conference and talking about how much progress we've made on those specific fronts. So those are our sectors that are really giving me a lot of optimism. Not only are they growing, these are sectors that pay, incredibly high wages. The average wage in the region overall for all private sector workers, about $40,000. Tech workers in this region make almost double that, right? So the average wage for a tech worker, that's all the way across the board from the folks who are, working in whatever occupation all the way on up to CEO. We're talking about average wages $70,000, $80,000. So when we talk about sectors that are going to grow the economy, create those kind of ripple effects, the multiplier effects, and really kick the region forward, these are the ones to keep an eye on. What about the buzz? We hear a lot, about the region, what our strengths and weaknesses are. If you're a news junkie like me, you probably heard some of these more recent forecast conferences talking about how we're even worse off today than we were, even during the downturn. Because today we just don't make anything anymore, right? Well, aside from the fact that that's wrong and just flat out incorrect. I think it also overlooks a lot of the key strengths, trends, assets that we have that are already in play and that we're going to continue to be able to leverage moving forward. So I figured it was worthwhile to take a minute to talk about some of those. First one, take head on, is that we don't make anything anymore. Well, no doubt manufacturing got hit during the recession, but you can see that we posted a couple of consecutive years of good growth on manufacturing output. That's true both in terms of non-durable goods, but also on the durable goods side. So things like our computers, pharmaceuticals, you name it. And in fact, the manufacturing sector, for the fact that we don't make anything anymore, really odd that those manufacturers went out and hired 3,500 additional workers over the course of the last 12 months. That's not something that you'd really expect to see if we didn't make anything, and in fact, that's just not the case. We make things, we're producing more, and unlike the rest of the nation where we're doing more with less workers, we've actually seen manufacturing job growth locally where we haven't seen it in the rest of the state and many other parts of the nation. So in fact, we're growing, and we're growing in terms of jobs, so actually more manufacturing opportunities overall. So I take issue with that idea that we just don't make anything anymore. We do, and actually that's one of the stronger growing sectors. In fact, I think if you count it out, it's 1, 2, 3, 4, fifth fastest growing industry in the region. So, flat out not true that we don't make anything anymore. We do. When you look at what we make, that also might surprise folks. Chemicals, computers, plastics and rubber, machinery. These aren't the kind of quote-unquote low-wage or just cheap dirt type industries that you'd expect to see, and I think goes kind of hand in hand with what we talked about with the rising growth in sectors like professional management, some of these more high-wage, high-skilled sectors. So not just that we do make things, we make some things that are really pretty important for the economy overall as a whole. The other idea that I kind of take issue with is how we're not worse off than we were before. In fact, if you just look from a wage standpoint, the average wage of a worker in inland Southern California, it's the highest it's ever been. On average, you never had a better chance of making more money in inland Southern California than you do today. I mentioned the unemployment rate, and we're down into that low 6% range, and that's true. But what's even more important is that the labor market has continued to expand. So it's not the fact that we just have, a low unemployment rate because we kind of lopped off all those discouraged workers and they're not being counted anymore, more of a kind of statistical anomaly or a statistical phenomenon. No, this is real live growth. This is due to genuine improvements in the regional economy. In fact, there's more people in our local labor force today than, again, at any point in the past. So this is due to strength, not weakness. This is a sign of optimism, not, worry for me. I think that the labor markets are improving, the unemployment's better, and it's better for all of the right reasons. How about home prices? That was one of the things that I thought, well, are we really worse off or not? I mean, when you look at what we're at from a housing standpoint, at least we're at a point today where home prices aren't sustainable. This is for the state overall. The region matches this trend pretty solidly. In fact, affordability has actually improved over the course of the last 6-8 months as interest rates have dipped back down. The cost of financing that median price mortgage relative to median incomes has actually dipped a bit recently. In fact, it still costs less than 30% of that median income to finance that median home at current interest rates. So, to me, that's not a sign of being worse off. Homes aren't at these unsustainable levels that are going to, precipitate some kind of a future downturn. The fact that home prices are within reach of folks' incomes, especially when you take into account this historically low interest rates, that's a good thing, not a bad thing. And that's something that I think shows that we are better off than we were in 2009 and 10. That's not to say that we don't have our challenges. The region does have challenges. There's no doubt about that. It's not about whitewashing those issues or kind of sweeping them under the rug. There's issues that we need to address and attack. For me, it's about really kind of taking the good with the bad and acknowledging that there are some really solid things that we can leverage going forward. But some of those challenges are demographic in nature, right? We've seen educational attainment start to grow, but we've still got a decent amount of folks living below that poverty line. Home ownership hasn't bounced back. That's largely a cyclical thing that was driven down by the recession, but still, we haven't gotten back to that level of home ownership that we had in the past, and median incomes haven't bounced all the way back. Again, that's largely driven by the cycle, but incomes haven't recovered all the way right? And that's something that we need to continue to focus on, is growing those incomes, getting folks back into those homes, getting people down below the poverty line by providing good work opportunities, and making sure that folks are able to take advantage of those. Some of them are structural in nature, right? So I talked about how the labor markets are largely recovered, right? We've created more jobs than we lost during the downturn, with some to boot. We're above that pre-recession peak by several tens of thousands, but that's varies on a sector by sector basis, right? So when you look at it on an industry basis, which I'm showing you on the right-hand side, anybody with bars sticking out on that right-hand side, that's the amount of jobs that we have above and beyond where we were even at the height of the last bubble, right? Back in 2007, which was our pre-recession peak. If you're a worker in logistics and healthcare and tourism, wholesale trade, professional technical workers, we have more jobs in those sectors today than we've ever had in the past. And those are one of the big driving forces behind the local recovery that we've had, at least in our labor markets. But on the flip side of that equation is there's still several sectors which were still well below where we were back in 2007. So although the labor market is quote unquote recovered, if you're an unemployed construction worker or somebody who used to work in manufacturing, you don't necessarily have the skills that are going to translate into some of these sectors that are really growing at a disproportionate rate, right? So if you're a former construction worker, you can't just immediately jump into some of these professional technical jobs or into these healthcare jobs that are really seeing this disproportionate growth. And I think that underscores some of the structural challenges that we have for getting folks geared up to be able to take advantage of these sectors that we expect to do really well going forward. And I think that really comes down to educational attainment, making investments in K through 12 all the way on up, and getting folks into UCR and CSU San Bernardino and all the rest, and getting them to stay in the region once they finish their studies and start their own companies, and really help to expand that skilled labor force. The good news on the education front is that we've made a lot of progress. We've gone from about 15% of our residents with a bachelor's degree or higher to about 20. The bad news on that front is that everybody else has also been boosting their level of educational attainment, such that we still maintain about an 11-12% gap with the rest of the state. So we're making good progress in terms of generating new skilled workers for our labor force, but we're also competing against folks who are trying to do the exact same thing. And so this is going to be something that we need to continue to focus on in order to continue to see that really solid growth in some of those emerging sectors that I mentioned earlier, like your biotechs, and things like that. So making good progress, but this is something that we're going to need to continue to make a concerted, conscious, focused effort to try and address and really get those levels of educational attainment up. We also need to better, accommodate population growth. We heard about this at the U.S. national level. This is true here locally as well. What I'm showing you is population growth in 5-year buckets relative to the amount of new housing that we've permitted over time. And you can see, especially in the most recent 5-year period, part of this, again, driven by cyclical issues, but we've seen over 250,000 new residents come into the region, either through births or actually positive migration. We're one of the few regions in the state that are seeing more people move in than move out. We've got positive net migration, but butted up against that 250,000 additional residents, we've only permitted about 40,000 or so new housing units. And so when we think about some of the structural challenges that we face going forward, it's that erosion of housing affordability and what that's going to do to driving up the cost of doing business, the wages that you're going to have to pay to offer folks that same quality of life. That's directly impacted by the fact that we haven't built enough housing to keep pace with the new population. And indeed, when you look at the outlook going forward, not just from our forecast, which tends to be optimistic, but even if you look at places like the Department of Finance, a huge chunk of the new residents that are being forecast for the state overall are expected to happen here in the Inland Empire. So this isn't just the UCR Center saying that the Inland Empire is going to do really well. Even folks up in Sacramento acknowledge that this is one of the growth regions. And so not only do we have this kind of deficit of housing that's accumulated over the years, we're going to have a lot more population coming online over the next 10, 20 20 years as well, and we're going to need to build enough housing to accommodate those folks as well. So we've got a hole to dig ourselves out of, and also a mountain of new population that we're staring down the barrel of too. So for me, this is going to be an ongoing concern in figuring out ways to get enough housing built so that we can accommodate this new population, these new skilled workers, attract those folks that we really need to grow those skilled sectors. These things all go hand in hand for me, and I think housing is perhaps right up there with education in terms of the single largest important issue structurally that we need to tackle going forward. That said, despite all these challenges, we have a huge amount of assets that we can leverage. This is one of my favorite charts is just the housing discount, the amount of money that you can save. This is a single example of comparing home prices in a place like LA to a place like Riverside County. And what you can see is that today you've never saved more money as a percentage of your home price by moving to the inland Southern California region than you save today. We're talking about 45, 50% savings over what you'd spend to buy that median priced home in the county of Los Angeles. When you're talking about a place with a median priced home of $500,000-$600,000, 40% savings translates into real money. Those are huge financial incentives for folks that are going to lure them out there. I mentioned this earlier, but we're already seeing that migration back to the inland areas as folks try and maximize that residential investment dollar. Now that we're part of the center, I can just hear my wife at home trying to say, hey, let's move out there and get a bigger house with a bigger yard, and we can let our dogs run free. And that's a powerful motivation from a quality of life standpoint, in addition to that strong financial incentive. And what you see is that we're already starting to see the effects of that on the right-hand side, this uptick in net migration. We'll get the 2015 numbers come out here in the next month or two, and I expect that we're going to see even more folks have migrated into the region, even more population growth coming online. And I think this is one of the big drivers of that, is just how much money you can save and how much you can improve your quality of life, right? That presents its own challenges. We do a lot of work for RCTC, and we see that there's ever-increasing demands for roads and bridges and things like that. And so it's going to create its own challenges in terms of developing infrastructure and keeping pace with things like that. But ultimately, this is a feather in our cap that's going to help us continue to grow and grow at a disproportionate rate. And of course, this is one of the biggest overlooked pieces, I think, of the region. When we talk about employment concentrations, which I touched on the front end, I said, yes, we are more concentrated in some of these lower wage categories, although we do have pretty strong concentrations in some other categories as well. And we need to continue to work on education, right, from K through 12, right the way on up the scale, so that we have a larger pool of skilled workers. But that's not to say that we don't have any skilled workers. In fact, we do have a lot of assets in the form of really skilled individuals that we can tap into over the short run. What I'm showing you on the right-hand side here is on a resident basis, occupation by occupation. These are folks who live in the region already, and what percentage of each of these occupations commute out. And what you see is that over 40% of our architects and engineers, our computer scientists and mathematicians, we have a decent chunk of these very skilled individuals here. The fact is just 37, 38, 40, 45% of those folks jump in their car and drive to LA, Orange County every day. So for me, if I was an economic developer here in the region, this is my biggest marketing pitch is, yes, we're going to continue to work on boosting those levels of educational attainment, but we've got a lot of these folks here already that we can tap over the short run, and they don't have to jump on the 91 or the 10 or whatever the case may be to shoot across county lines. These are folks that are here right now, that we can actually tap into for fostering growth in some of those categories that we really want to see emerge. And this brings up another point, right? I talked about workers versus residents. Here's the graph I showed earlier, right, where we're more concentrated in some of these sectors like logistics, like construction, like retail trade. This all pertains to the employment at firms located in the region. When you flip this on its head, you get a slightly different picture of what the overall strengths and weaknesses of the region are. When you do it on a worker basis, what you see is that our concentrations in things like logistics, like construction, are much smaller than what you see on the basis of folks who have firms and operate within the region. Our residents are much more high skilled. We've got larger concentrations in things like information technology, management, professional services. When you think about the folks who actually live here irrespective of where they work. So again, when we think about how do we grow the economy over the short run, let's tap into some of these really high-skilled residents that are already in place while we begin to tackle that kind of 10, 15-year challenge of getting the educational attainment levels up to where we want them to be. This is something that we can take advantage of right now. It's going to be better for those workers who don't have to jump in their car and drive an hour or two. It's going to be better for traffic and congestion. And it's also going to be better for overall economic growth in the region as these folks work closer to home. We generate new homegrown businesses and really see some of those emerging sectors continue to do very well. The thing that gets me optimistic is that we're in a position to where we can start to address some of these challenges, right? We went through the business cycle and we talked about how the labor markets are recovered and the GDP is growing. The fact that the economy is doing well and seems to be firing on all cylinders, that's going to give us the breathing room to tackle some of these longer term challenges. I'm so proud to be part of this center, because I think it really is a function of getting the research, having the conversations with business, having the government be actively participating so that we can all figure out what those best solutions are together, and just to be able to have that conversation on an ongoing basis through the center is a positive one. And the message that I would say to all three groups is that now is the time to start addressing some of these longer term things. We're not in a triage mode. We're not in crisis management mode. We can really kind of be thoughtful about tackling these challenges to make sure that we're not just a fast-growing region, or that we're not punching above our weight now, but that we continue to punch above our weight. I want to go through some of these other optimistic spots in the economy because consumers are a big part of it. We've spent more in the last year than has ever been spent by residents in the region. We've had more taxable sales than ever before. We've seen more spending. That's true in virtually every single category. The real estate market continues to do well. We've started to see home sales pop up, and of course home prices continue to grow. They've started to taper recently, but this is something, again, that's not just concentrated to one particular sub-market. It's not just our core areas in the city of Riverside, which is doing well, no doubt about it, but this is something that we're seeing all the way across the region, from Southwest Riverside all the way up into the high desert. This is a broad-based recovery on the housing side, same as it is on the consumer side. See the same thing on home sales. A lot of different areas throughout the region are seeing home sales. So again, we're not just a one-trick pony with all of our eggs in one basket. This is something that's pretty broad-based across the entire region. Builders have started to jump back in the market. There was a big drop-off in multifamily permits recently, but that's because we've permitted a ton of new multifamily buildings. This is, all those new permits have come online. It's a huge growth from what we were doing several years ago. We've still got a big hole to climb out of. That said, at least things are moving in the right direction. Builders seem to be optimistic. They're looking down the barrel of this population growth and bringing new units online. That's something that we want to encourage and make sure that continues to happen, again, so we can stay ahead of this housing affordability issue. Results have been more mixed, but still seeing pretty broad-based growth, especially on the single-family side, which has really started to accelerate recently. The I-10 corridor, the Corona area, High Desert, Moreno Valley, this is stuff that we're seeing, again, not just isolated to one particular part of the region, but really we're seeing construction happening in a lot of different areas as well. Of course, tourism is something that we're not necessarily particularly known from, but it's something that's really also a feather in the cap for the region. Hotels are busier than they've ever been, and not only that, they're renting out those rooms for more money than we've ever charged before. So great time to be in the hotel business in inland Southern California. And again, not to sound like that broken record, but this is something that's happening all across the region. It's not just one particular, hotel, although the Mission Inn seemed to be pretty buzzing last night. This is something that's happening, right the way across the region. Logistics, trade's been choppy. We've seen some ups and downs at the port, and I know the port's a big driver, especially of our logistics industry here, and a lot of concerns about what's happening on the exchange rate front. And yes, the dollar has appreciated pretty spectacularly against the Canadian dollar or the Mexican peso, which are our two largest trading partners. That said, I think logistics should remain pretty solid here in the region, irrespective of what happens on the export front, because don't forget, We process a lot of imports as well. So as our dollar becomes stronger, more goods come in through the ports on an import basis, and those are going to need to be distributed throughout California as well as to the rest of the U.S. And that's going to provide a buttress for the logistics sector, and also a lot of the local logistics sector, especially more and more with things like the Amazon Fulfillment Center and things like that. They're not import-export focused. A lot of the logistics today is more domestically oriented, fulfilling domestic demand from online sales and things like that. And so that's going to provide another backstop against any problems that should bubble up on the international front or with the exchange rate and things like that. Logistics should stay strong here in the region, irrespective of those things, because of A, imports, and the fact that B, a lot of that business goes to fulfilling domestic demand. The commercial markets are better, they're improved, but it's just been a much more bumpy road. It's been a longer road to recovery. When you look at local vacancy rates, you can see that office vacancies are still in the kind of 20% range. We have dipped below the 10% vacancy rate number in terms of our overall retail space. Below 10% is where we usually see more growth in things like construction, rent growth. But despite those kind of relatively high levels of vacancy, you can see that rents are growing, and they've been doing so for the better part of 2 years now. So although we have these relatively high office vacancies, that's an overall number. And I think when you look at it on a product-by-product basis, when you look at specific class of office market in particular, particularly the high-end Class A space, doing much, much better than this kind of overall headline number would have you believe. And I think that's going to be an ongoing challenge. In fact, when you look at the non-residential construction numbers, you see big increases in office construction. Well, how can that be? How can we be building new office space when we've got over 20% vacancies in our existing office stock? And I think it's all about having the right kind of product. The name of the game is what your product looks like and who you can appeal to, and it's about modernizing that stock and creating these kind of new workspaces that are really desirable. Yes, the old 40 and 50-year-old Class B and C buildings, they are maintaining relatively high levels of vacancy rates, but some of these new buildings with the more modern type setups are really doing much, much better than that overall headline number can have you believe. And in fact, we're seeing builders kind of take advantage of that trend and really start to modernize that stock with growth of new office permits, alterations and additions. But we're seeing all kinds of new non-residential construction above and beyond just office, and things like industrial, which again has been doing really well, no denying that. But we're also seeing it on the tourism side, office side, and other things like new medical facilities, which I think are going to be a real big asset for the region going forward as well. All that being said, I think it's not going to be any surprise that we're optimistic on inland Southern California. The forecast remains positive. In fact, we expect population growth to remain strong, somewhere in that 2% range over the course of the next couple years, expecting to see above average employment growth sustained over the course of the next couple years, growing above 3%, better than what we expect to come down the pike from the state of California overall. Home prices we see continuing to grow, even picking up a bit as those kind of retail buyers jump back into the market and home sales start to pick up. Folks are better able to get those mortgages. That's going to continue to drive some pretty solid growth on the home price front. And of course, home sales are going to continue to grow right along with those, growing economic conditions. Permitting, we expect, will continue to grow, but that's something that, can't grow fast enough from my perspective. When you look at the deficit of housing that we've built up over the last 2 decades, along with the needs that we're going to have for future population, that's going to be something that you want to continue to make sure to keep an eye on so that we are accommodating that new population and consumers can do better. But, look, for me, the story is, the big punchline is that it's time to look ahead, right? The cycle is over, the economy's growing, housing is doing well, even manufacturing is doing well. We do make things. Let's try and start attacking some of these long-term challenges. That's everything from education to housing to, leveraging our high-skilled residents who are already here and commuting across the border. Let's find ways to get those folks, making things happen closer to home. And of course, along with that goes our infrastructure needs and making sure some of these issues are getting pressed in Sacramento. So really keeping our kind of the pressure on those folks up in Sacramento to make sure that some of these concerns that are, largely statewide jurisdiction, but really have local consequences, continue to get pushed forward in a way that's really going to help us continue to be a growth region and an area that not only is growing, but is punching above our weight and really driving the California recovery forward. So, for me, I'm optimistic, and I really thank you for listening.